I think in the case of both Turkey and Iran, it's very, very specific to their relations with the US. I think if there's going to be any spillover, it's definitely these trade issues that is kind of simmering out there for quite a while. And I think markets are going to be more concerned about that. I think as far as Iran is concerned, the major exports they have is oil. I mean, that may have an impact on oil markets. But beyond that, not much.
And let's talk about that then, because that is the clear negative feedback loop. That's transmission mechanism through the oil market. There is a risk that we see US sanctions reimposed on Iranian oil come November the 4th. Is there an associated risk that oil, therefore, could retest $80 a barrel?
Oh, definitely. I think the question here is about demand and supply. Right now, who's going to make up for that loss of supply? Most people feel Saudi Arabia and the other oil-producing nations, but I don't think they got that much spare capacity out there. So it's a question of what the market perception is going to be. Growth still remains quite strong around the world, so demand for oil is going to remain strong. And we do feel that, where we see oil today, the chances of it moving higher is, I think, much more than of it falling back lower.
What does that mean for demand and economic momentum out here in emerging Asia? And is there a price level or a price range or a pinch point at which higher oil starts to become a tax on consumers?
Well, I think usually when commodity prices go up, emerging markets tend to benefit because they tend to be exporters of commodities. So I do feel that maybe, except for maybe a few economies that kind of tend to import a lot of oil, generally oil tends to be a beneficiary to these economies rather than a detractor. Now, of course, if oil shoots up to over $100 or something like that, then definitely in the short term, depends on how you get there. It's not about where you get.
Whether it's a disorderly move or not.
Yes, I mean, if it's a gradual, slow move, then the market tends to adapt.
So we shouldn't expect any quickening of the inflationary impulse on the back of this, because ultimately that would be growth negative. Are there any implications we can draw on central bank policy as a result of higher oil prices?
Oh, definitely. I think central banks will be keeping a close eye on it. I mean, all kind of filters through the economy. But so far, it seems like we're not seeing the kind of inflationary pressure that is causing central banks to get worried about. One of the biggest worries in the past was that we didn't have enough inflation. And finally, we are getting inflation back to that 2% level in most of the economies.
But it's not the right type of inflation, is it? It's the cost push inflation, which, and again, if you throw in tariffs to this, and Emily was talking about higher, we are seeing cost rising across the board in the corporates, and that means margin erosion.
Yes, agreed. So it is a question of how we kind of play this, in the sense that inflation, a bit of inflation is good. The question is where it comes from. In the past, inflation used to come from wage increases. That is not the case this time. This time is much more cost-based. And how do companies adapt to it? They basically keep on cutting costs, and we are still seeing that. Even though the US and many economies are kind of doing much better, you're not seeing wages go up because companies are still on that drive to gain efficiency. So we are going to continue to see that. I mean, in the US, companies are investing more and more in automation. Jobs are being lost and wages are not going up, but companies are getting more efficient.
Hey everybody, it's Hadley Gamble from our new CNBC Middle East Bureau in Abu Dhabi. Thanks for stopping by. Now to watch more, you can try one of the videos that just popped up on your screen. And don't forget to subscribe.